Good morning, everybody, and thanks a lot for coming, and thank you to the CSC for having me. I am new to Kelowna, so originally from Toronto, 20 years in Toronto, moved out here a couple years ago and loving it. I'm going to take a little bit of a break here from the overload of the ESG and start talking a little bit about investing and communications around investing as well. So yeah, Sophic Capital is a capital markets advisory firm. We're based out of Toronto. I started my career for about 10 years, was a sell-side analyst covering tech and clean tech, and then now we basically help small, innovative companies tell their story and create a capital market strategy so that they can lower their cost of capital. Okay, so the problem. So basically the problem is all these innovative companies, they spend all their hard work, they spend about 5-10 years building their businesses generally. They put all their blood and sweat and tears into it. The problem is when they get up in front of investors and they talk to them, they don't actually talk about what investors want to hear. And this is one of the big problems that we find in these businesses. So there's only really two questions that investors want to answer. The first one is, am I going to make money when I invest in this company or in this stock? And the second one is, does this company going to have to raise capital? And especially right now with the cost of capital that's increased and the inability to raise capital, this is extremely important right now to understand that if I invest now, at least the next round is going to be higher, and how is it going to be higher, and how am I going to do enough due diligence to understand that I'm going to be right? So we're also investors in the space, so we are top-down micro and small cap investors. And so in that regard, we also have looked at many pitches. We know what people are saying, and so it's a market where there are few players now. Hardly any institutions are left. We've got mostly retail brokers who are left that are investing in this space, and that provides advantages and disadvantages. So as far as advantages, all big companies started as small companies. So everyone, invested in Amazon, Tesla, you name it. All these companies started as micro-cap companies at some point. And so the opportunity to make outsized returns is there, and that's kind of the big carrot that's dangling in front of everybody to get in here. It's largely ignored by the street. There's not a lot of analyst coverage. You've got to do your own work. You've got to be better than it's easier to beat the market if you're smart and you know where to look, but it's also a riskier market. Management's available. You can get in touch with management. Unlike, you're not going to be able to get in touch with Toby at Shopify. You're going to get somebody else 4 places down the line. You're not going to know what's going on. And so, you actually can get access to management in these companies, which means that you can find and ask questions that, really help with your own personal due diligence. Some disadvantages, sometimes these companies go to market too soon. We've seen a lot of stocks being promoted almost like products, and so you have to be careful about what you're reading. Often they need more capital. So in our business, all of our companies are growth companies. They always need more capital. They need to be sending the right message to investors so people understand that what they're doing is they're actually building a real business. And then, they're illiquid. So these stocks are very illiquid, meaning that you can get trapped in them. In COVID, stocks that were up 5 or 6 times from initial investment were back to where they were, and you have to make a decision. Are you going to be buying more of these? Are you selling them? So, you have to be, patience is really necessary here, and you've got to have a very long-term view. Unless you're a trader, which I'm not, I'm a long-term person. I'm looking for real businesses that are going to grow over the long term. The way to do this is to continually monitor the companies, continually talk to the management team, and be confident in your analysis and due diligence so you can be there in COVID and you can be there and buying these things when you're at the lows, when everyone else isn't there. So tips for buying these companies, as I said, do a lot of due diligence. So there's a lot of public information that you can get on MD&As and financial statements, and there's a lot of what I would call noise in the market right now on boards and places where you can find information. But if you actually go to what the lawyers tell the companies they have to say and read those documents and then form your questions around those and use financial statements, I think you'll be better set to kind of understand what's going on. Gradually build your position over years. I mean, I've bought companies that, are up 5 times and then COVID hit. They're back to where I bought them. I'm buying them again. They're back up 5 times. Now they're down, not back to where they were in COVID, but they're down and you're buying them again. And so over time, as long as the company's doing what they said they're going to do, you're going to have an outsized position in an illiquid stock, and you're going to have better information than anybody else. And it's almost like, everyone thinks that the analysts know everything about what's going on in those companies. They do, because they follow them every single quarter and they do all the work. And so if you take that approach as an investor yourself, you're going to be, in much better stead when things go wrong. You're just going to feel more confident to be able to step in and buy these things. And then just ignore some of the social media. There's a lot of stuff on Twitter, TikTok. It's a very different environment than it was 5 years ago. So I would just say be very careful with those types of things. And I tell my children all the time, if you see something on the internet, go find it 2 other places and make sure that it's the same. Otherwise, throw it in the garbage. And so, be careful there. Board of directors, really important. A lot of these companies have friends that are on the board. They're called independent directors. They're not. You should see boards flipping out. You should see members of the board leaving every 3 years or 4 years. They should have a process to do that. And so governance is really important. So where do I look? Where do we look? We look at what industries are going to kind of do well. So, over the last 5 years, we've been investing in digital transformation in big companies, machine learning. People are now really excited about AI, but we invested in a machine learning company 5 years ago that had, very little revenue, that they're using data to reduce and stop pipeline leaks, which they've done, and they're now going to do 10 million in recurring revenue. And so we try to go to where the market's going to go, and then we look for the companies that are going to fit in there. So what do we do when we're looking at these companies? We look for disruptive businesses. We're kind of clean tech and tech investors, so we want to see something that's faster, cheaper. They have some kind of secret sauce that we think they're going to be able to beat the market. Next one is a large market opportunity. We're not interested in investing in a company that can only do $5 million. It's not going to be interesting, especially for the public markets. It's got to be a really big opportunity and very disruptive. Solid management team. These are obvious, right? Like, obviously you want a good management team to be running the company, but look to past performance, what they've done in the past. Make sure that's a broad group of individuals who are working at the company who understand kind of all aspects and facets of basically taking this thing forward. We work mostly with founder-based businesses. The reason we do that is our goal is to lower your cost of capital. That's our only goal for when we're working with a business. Our goal is to basically, if you raise money at $1 and your stock goes to 20 cents, you don't need to raise money. We've done our job. We now need to raise money at over $1, and so how are we going to get back to that position, right? And so lowering your cost of capital is the key thing. Insiders that highly own their stock protect their stock, and they also make better financing decisions, I find. Strong moat, IP, could be like unique data sets around AI. All those things matter in this, and so there's 100 different ways you can look at a moat, but something that keeps competitors out. I always say this: competition kills stocks. Seen it 100 times. So when new comes in, they've got something new and disruptive. That's the company you want to own, but they disrupt it, and it basically kills the other group. Finally, a large customer. These are early stage companies, so if you have one large customer that's paying, not free, paying market price for the product, and I say is the dog eating the dog food. If you have a large customer and that customer represents a significant portion of the market, chances are the rest is going to fall, and so we always look to this large customer. Finally, strong balance sheet, financial plan. This is a big deal for obviously question number 2, which is the company going to need capital? So go look at the burn rate, go look at the financings, go look at when debt is due. Make sure you understand all the financial aspects, and then understand the model of how this company's going to get to break even, because a lot of them aren't there yet. Okay, I have hardly any time left. So for issuers, they have to answer question 1 and question 2. Are you going to make money, and do you need to raise capital? And so, a couple slides here, just keep it super simple, right? You don't want to be talking about, the widget you built and how you did it, and, the fact that you're using AMD's chip instead of someone else's. Like, people want to understand the big picture. They want to understand how they're going to make money, and then they want to understand that you don't need capital. And so keep that kind of in your message. That's what we do. We kind of bridge the gap between investors, and I was going to actually provide some examples, but I think I'm pretty much out of time here. So just to sum up, I think when you're investing in this space, make sure that you do your due diligence, look at credible sources for information. And there's a lot of great innovative companies in Canada, and there's a lot of great companies on the ESG side of things that are doing things that I think are going to benefit the environment and the economy at the same time. You want both those things. And that's it. Thank you very much.